The stock market is doing some really crazy things. Over the past 18 months, we've seen major swings in both directions. Now it looks like we're at the peak of the frenzy, which probably will be short-lived as interest rates start to rise in the coming weeks. If nothing else emerges to burst this bubble first, an aggressive hike in rates will definitely calm down this madness. In fact, as valuations reach the highest levels in history, the worst stock market forecast of all time is about to come true. The Dow Jones Industrial Average is on the verge of breaking 36,000, and most investors are still believing that the bubble will continue to be sustained at that level while stocks soar to new record heights. But without the Fed's easy money, there's simply no way to support such hyper-inflated valuations any longer. While many are eagerly expecting the market to break the 36,000 benchmark, they may be forgetting that this is quite a famous number on Wall Street. In 1998, when the dot-com bubble started to form, journalist James Glassman and economist Kevin Hassett wrote a Wall Street Journal piece called Dow 36,000, the new strategy for profiting from the coming rise in the stock market, which became a massive bestseller at that time. Maybe you even read this. The investor mania triggered back then was so strong that although the market's average was standing at 8,782, significantly lower than their forecast, shortly thereafter, a sizable stock market crash followed. 1 year later, the authors suggested that the index would hit the magic number in 5 years, but it took almost 22 years for the conditions to improve and the Dow to finally be in a short distance from that prediction. Even though the timing of the forecast was wrong, they have learned one lesson with the sudden dot-com crash that remained true throughout all of this time. When investors get blinded by the idea of having huge returns in a short period of time, and they ignore red flags signaling that the economic conditions cannot sustain that growth, disasters occur. Back then, as investors focused on the headline number like it was gospel and kept fueling the bubble as much as they could, they lost the notion that at some point stocks go through a test of resistance. That is to say, companies whose stocks are leading the market rally have to prove that valuations can be justified by their own growth. And when they cannot prove it, things start to go downhill pretty fast. It is safe to say that most, if not all, of the companies whose stocks are at the top of the market right now will have major trouble proving that their growth and their production can keep up with their extreme valuations amid a historic shortage of workers, supply chain disruptions, an alarming energy crisis, rampant inflation, and the threat of a double-dip economic recession. Well, every rally has to end sometime, right? And in today's market, there isn't just one, but many factors that could become catalysts of a massive crash. Over the past 2 days, the estimates of higher inflation alone have sparked substantial drops in the tech sector. Market watchers have been saying that the tech bubble could lead the whole market to tank in the blink of an eye, which makes the situation particularly precarious. Up until now, several tech names have done pretty well. Some may even say too well, considering tech production has significantly declined due to an ongoing shortage of computer chips. Other fundamentals, such as the Shiller price-to-earnings ratio, are indicating that today's price-earnings rate is at a level that largely surpasses the run-up to the 1929 crash and is nearing the record set right before the 2000 dot-com burst. At the current stage, it's not just technology stocks that are in bubble territory. Communication services, consumer discretionary, property, and cryptocurrencies are in a huge bubble just as well, and the fact that all the other areas of the market are affected by these stocks shows that every single asset class has also been sucked into this bubble that is now about to burst. That's what one of Wall Street's most experienced investors has recently warned. Alistair Nairn, a historian and professional investor, predicted both the dot-com and subprime collapses. Now, he's telling us that we're on the brink of something even bigger. In his new book titled The End of the Everything Bubble, he warns that we are living in a period of deadly excess and a financial catastrophe is closer than most people think. Nairn highlights, markets may appear to be going up and up, but they have got perilously ahead of themselves. Danger lies in every single investable asset class. Alistair Nairn continues, what some have called the everything bubble has inflated to unprecedented proportions. The investor argues that signs of excess are visible everywhere. You can see it in the price of Bitcoin, he says, in the exalted levels of share prices, and in the mania for online gambling. The bubble can be seen in the majority of investment assets, from classic cars to modern art. These are clear echoes of the dangerous behavior which preceded the great stock market crashes of the past, Nairn alerted. Interest rates are at their lowest level for 5,000 years, while governments have accumulated record amounts of debt. An incredible $75 trillion worth of global investment wealth is under threat. And now, the bubble is about to burst, Nairn warns. The truth is that the recent rally is more problematic than before. Stock prices are not growing because of improving fundamentals, but because of investors' additional risk-taking. That leaves the current market growth on very suspicious and fragile ground. Given that the growth rate for earnings next year is dropping and has been steadily falling, the Nasdaq gains are unlikely to hold, and when things finally start to falter, the crash shouldn't come as a surprise, since there was no basis for this rally to happen in the first place. In fact, that meltdown has already begun. About a week ago, the electric vehicle manufacturer Rivian went public, rapidly became the second highest valued automaker in the US and the third most valuable automaker in the world, having accumulated more than $100 million by the end of its first day of trading. The company that has sold less than 200 trucks and makes almost no revenue has torn out the gates, with its shares soaring as much as 130% above its $78 IPO price. However, when the company started to burn billions of dollars in cash to ramp up manufacturing capacity to meet its target of making 1 million vehicles a year, investors started to question what Rivian's profit margins would look like after the company begins to deliver vehicles to customers. That tiny shred of mistrust led Rivian's shares to crash on Wednesday, blowing some air out of the tech bubble. Rivian stock were only behind Tesla and Toyota's, but ever since other consolidated automakers announced plans to produce electric cars as well, the debuting company's shares started to look less appealing. Rivian's collapse exposes how fast a downturn can occur. With so much uncertainty, investors must brace for a wild ride in the coming days. Even the investor made famous by The Big Short has sounded the alarm about a looming stock market crash sparked by the tech sector. In a recent tweet storm, Michael Burry posted a link to the editorial board of the Wall Street Journal, headlined Rivian, the Government Unicorn, and subheaded, the EV truck maker is worth $120.5 billion. It has sold 156 vehicles. Referring to the speculative frenzy that led the company's stock market to skyrocket, despite having no ground to sustain that growth. At the same time, the most popular and, without a doubt, the most overvalued stock in the market today belongs to Tesla, the great leader of the tech bubble, and Tesla stocks have been sharply collapsing lately, suggesting that booming days are coming to an end. Michael Burry also warned this week that Tesla CEO Elon Musk is likely selling the company's stocks to cover personal debts, and warned that the automaker can lose up to 90% of its value in the coming stock market crash, just as happened to many firms during the burst of the dot-com bubble. He noted that even Elon Musk admitted that the company was overpriced in May 2020 when it was nearly 16% lower than its current value. The tweet has since been deleted. Burry outlined that stock market speculation is at levels not seen since before the 1929 crash, and assets today are far more overvalued than before the dot-com bubble burst. On the same theme, the legendary investor and chief strategist of Grantham, Mayo and Van Artelu, Jeremy Grantham, stressed in a new Bloomberg interview released this week that although Tesla is at the top of the tech bubble, Elon Musk's electric vehicle company has zero chance of meeting its shareholders' massive expectations. And when they realize that, it's game over. Tesla's valuation assumes it will not only be brilliantly successful, but multiplies as successfully as the FANGs, which are some of the great companies in the history of capitalism. That is a big ask, he says. Every great automobile company, Mercedes, BMW, Volkswagen, is gearing up to go electric. Tesla's going to have some serious competition. Living up to the expectations of the stock price will be impossible, explains Grantham. The investor also sounded the inflation alarm, slamming the Federal Reserve for fueling the bubble, and reiterated his warning that the worst market crash in U.S. history is right at the corner. There's a bigger buy-in this time to the idea that prices never decline and that all you have to do is buy than there has ever been. When the decline comes, it will perhaps be bigger and better than anything previously in U.S. history, he cautioned. In his view, all of the blind optimism and speculation going on right now will leave investors scrambling when highly leveraged stocks go through a reality check. This is the first time that inflation, the number one predictor of a market downturn since 1925, is being ignored, he says. Every bull market before this one had low inflation. In order to explain today's market, you have to assume 100% ignoring of the rising inflation, which is quite remarkable. We've never seen anything like this. Grantham questioned the role the central bank had in propping up the prices of worthless stocks. The Fed hasn't done a thing right since Paul Volcker, who was brilliant. All of the other chairs have encouraged a series of really dangerous asset bubbles. They overstimulated to get to 2000. They overstimulated in the mid-2000s housing market. And have they learned? Absolutely not. Did you need to throw this much money all over the world so that it flows into the stock market and creates these meme stocks? The craziness that had Avis stock triple in one day? He continued. This is more extreme in scale and size of the market cap than anything that occurred in 1929, even adjusted for the size of the economy, Grantham concluded. That's the very reason why so many market veterans have been coming forward to alert that the coming stock market crash will be the biggest and most devastating ever. The nation's easy money policies are set to expire in a few short weeks, and if a black swan event doesn't emerge to catalyze an unexpected meltdown, that alone will be enough to deleverage stocks and set off an 80 or even 90% drop from today's highs. Don't be mistaken. The current rally will rapidly burn, and stockholders will find themselves dealing with a rug-pulling flash stock market crash before year's end. They may never get a chance to reposition their portfolios because they simply don't see it coming. People still want to believe that the market will stabilize at record highs with no liquidity support. That could not be farther from the truth. It's a completely absurd idea. The more the bubble inflates, the higher the risks get. And at this point, you cannot say you have not been warned.